Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of Exxon Mobil Corporation, ticker symbol XOM. Exxon Mobil is one of the largest integrated oil and gas companies, and recently these integrated energy companies have done extremely well given the increasing price of oil and natural gas. We've also seen a number of super investors invest into the energy sector, including Warren Buffett, who over the past year or two has been steadily buying into energy-based businesses, including Exxon Mobil's main competitor, Chevron. Part of Buffett's reasoning for investing into energy companies is likely because he believes the price of oil is going to be higher over the long term than it has in the past. That was originally why he gave financing to Occidental Petroleum to purchase Anadarko prior to the COVID-19 pandemic, and it's likely why he's been investing into Chevron and Occidental since then. Very simply, the hypothesis of higher long-term oil prices, combined with these types of businesses not reinvesting as heavily as they have in the past into oil production capabilities, means that these businesses have a lot of cash flow that's freed up that will go to service their debt load, paying back a lot of their debt, and additionally return capital to shareholders through both the forms of dividends that they have now started issuing again and stock buybacks over the long run. That would appear to be Buffett's pretty simple hypothesis here. We're looking at Exxon Mobil today to see how the business's fundamentals compare to that hypothesis going forward. So currently, Exxon Mobil is trading for $99.19 per share. Over the last year, their stock price is up 62%, so they've done extremely well. Over 3 years, even taking a huge dip in March of 2020, Exxon Mobil is up at a rate of 13% compounded annually. Over 5 years, they're only up at 4% compounded annually. Over 10 years, their share price is only up 7.5%. They're compounding at a rate of less than 1% annually. And going back prior to the global financial crisis, Exxon Mobil's share price is only compounding at a rate of about 4% annually. Their share price has not even doubled over this time. Keep in mind though, for the majority of this, Exxon Mobil has been paying a very high dividend yield. That would be in addition to the return of their stock price. Currently, Exxon Mobil is paying a 3.55% dividend yield, which is about double that of the dividend yield from an S&P 500 ETF. Exxon Mobil is about $5 under their 52-week high. They're up nearly double from their 52-week low, and they are an extremely large business. They're one of the largest businesses in the world with a $413 billion market cap. For more background about the business, Exxon Mobil is an integrated oil and gas company that explores for, produces, and refines oil around the world. In 2021, it produced 2.3 million barrels of liquids and 8.5 billion cubic feet of natural gas per day. At the end of 2021, reserves were 18.5 billion barrels of oil equivalent, 66% of which were liquids. The company is the world's largest refiner with a total global refining capacity of 4.6 million barrels of oil per day, and they're one of the world's largest manufacturers of commodities and special chemicals. As of the end of last year, Exxon Mobil had approximately 20,000 net operated wells with proven reserves. The company was founded in 1870 and is headquartered in Irvine, Texas. For our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist approach of 6 standard financial metrics to come to a holistic and beginning understanding of Exxon Mobil based off of their business fundamentals. So this analysis is still a work in progress, it's still evolving, and it will continue to improve and get better over time. It's also an opportunity to learn in public. So with that said, let's get right into our analysis. Starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So there are a couple of reasons for this. The first is that over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these business returns are captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital. So by asking for 14% here, we can build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Exxon Mobil's return on capital was pretty average coming into the COVID-19 pandemic. Things got pretty bad as the price of oil and natural gas plummeted, and they produced negative returns on capital in 2020. Since then, as these commodity prices have gone higher, their returns on capital have significantly improved. Last year, they earned about 11% return on capital, and so far over the last 12 months, they're earning about 20% returns on capital, which are very good. However, they're a commodity business, and while they are a very large business and potentially have a low-cost producer advantage because of their fixed costs spread out over greater operations, their returns on capital are heavily dependent on the price of oil and natural gas. And so over this time, they've only earned a little under 6% returns on capital on average. Even though they're earning about 20% currently, this is still going to be an X on metric number 1 to start things off here. Metric number 2, here we're taking a high-level overview of the cash coming into the business. We want their revenues, net incomes, and free cash flows to have grown in the last 5 years. Even though we saw this big dip year over year from 2019 to 2020, where their revenues fell by a lot and they had both negative free cash flows and negative net incomes, over this 5-year span, they've actually grown revenues and they've increased their profits from the business. So both their earnings and their free cash flows are up as well. This is going to be our first check here on metric number 2. For metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Exxon Mobil's profits on a per share basis. Specifically, we want to see earnings per share growth over the last 5 years. This is building off of the previous metric where we saw their earnings go up. Over the last 5 years, we've seen earnings per share growth. One small thing to note here is that their earnings per share have grown just slightly faster than their earnings have over this time, and this is because the company has bought back about 2% of their shares outstanding. Not a lot of buybacks. That would be a good sign to see for long-term shareholders of the business if those buybacks occurred when Exxon Mobil was trading below its intrinsic value, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that business, and when a business buys back shares and decreases the number of shares that they have outstanding, they're increasing your ownership percentage of the business, which is ultimately going to increase the percentage of the business's profits you're entitled to. So for Exxon Mobil, we've seen both their profits go up, and if you were a long-term shareholder in the business, your percentage of those profits would have gone up slightly as well. Good sign here that they were not massively diluting shareholders despite their hardships in 2020. This is another check on metric number 3. Metric number 4 is going to be very similar. Here we're looking for 5-year free cash flow per share growth. Their free cash flows per share have more than doubled over this time period, and the business's profitability has rebounded quite strongly since 2020. They're putting up very high numbers for shareholders in both 2021 and over the last 12 months so far. So this is another check here on metric number 4. So far through 4 metrics, we have 3 checks and only 1 X. Next up for metric number 5, we want their net debt, which are short and long-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that Exxon Mobil has produced over the last 5 years. This will help us evaluate how the business is levered and if they're employing too much debt in their business. Exxon Mobil had really high debt loads in 2020. They took on about $19 billion additionally in net debt between 2019 and 2020. However, as their free cash flows rebounded, they've aggressively paid back this debt. At the end of last year, they had about $46 billion of net debt. Currently, that's down to only $28 billion of net debt. And over this 5-year time frame, they've produced about $70 billion of free cash flow. So the business is in healthy shape to be able to support this debt load going forward if their free cash flows continue to be high. Additionally, over the last 12 months, Exxon Mobil has earned $49 billion of free cash flow. So that is a ton in comparison, especially to these years pre-pandemic. So Exxon Mobil looks like it's in a very strong cash flow generative state here. This is another check on metric number 5, and we're not seeing clear indications that the business would be overly levered here. Finally, the big metric of them all, metric number 6, we want their average 5-year free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a reason to potentially be interested in the business, as it would give us a slight risk premium to the risk-free rate of the 10-year treasury. So we're using total enterprise value here instead of ExxonMobil's market cap, because total enterprise value is going to incorporate both its market cap and its net debt position. It'll give us a picture that's more reflective of economic reality and more akin to ExxonMobil being valued as a private business. Currently, they have a total enterprise value of $448 billion, and we learned that in the last 5 years, they produced $70 billion of free cash flow, which means that they're producing about $14 billion in an average year. So when we divide their average free cash flow of $14 billion a year by their $448 billion total enterprise value, that is going to give us an average free cash flow to enterprise value yield of only 3.1%. So that is going to be both below the rate of the 10-year treasury and that 5% mark we were looking for. So this is going to be an X here on metric number 6. However, it's worth noting that over the last 12 months, they produced $49 billion of free cash flow. So to get a current free cash flow to enterprise value yield, when we take their $49 billion of free cash flow generated over the last 12 months and divide that by their total enterprise value of $448 billion here, we get a current free cash flow to enterprise value yield of a bit under 11%. That would be well above the mark we were looking for. And that's a very strong cash flow yield for pretty much any business across the board. So because their average free cash flows compared to their current free cash flows are on either side of this 5% mark here, this X doesn't have as much weighting as it usually would. And this potentially means that Exxon Mobil is an interesting business to look at, especially as their recent business results have been quite a bit better than what they've been historically. And if the price of oil and natural gas stay high, which seems to be Warren Buffett's thinking about investments in integrated energy companies, then Exxon Mobil could be especially interesting here. So here we're looking at Exxon Mobil's dividend profile. So Exxon Mobil is a dividend aristocrat that has consecutively increased their dividend payments for each of the past 39 years. Additionally, they have a 3.5% dividend yield currently. And so it's really easy to make mistakes by blindly chasing dividend yield or a dividend track record. Instead, it's worth your time if you're interested in a business for its dividends to look at the underlying fundamentals of these dividends. So depending on the type of business, you want a company to be able to support its dividends through either its earnings or its cash flows. For Exxon Mobil here, we want to see that their dividend would be supported by their cash flows in each of these 5 years. This is a mixed bag here. They were just able to slightly support their dividends in 2017 and 2018. Their cash flows did not support their dividends in 2019, and especially when their cash flows became negative in 2020. But as the company has rebounded, they're now producing quite a bit of cash flow relative to the dividends that they're paying out. It looks like their dividend payments are in healthier shape currently. However, it's not great capital allocation to see that they continuously increase their dividend just to keep up their track record, even in these 2 down years in 2019 and 2020. From a shareholder's perspective, yes, it is nice that they kept up their dividend track record, but again, this is not great capital allocation here. Then finally, here we're using a discounted cash flow model to come to a potential fair value for Exxon Mobil. For many businesses, we would be starting with their current free cash flows. Because Exxon Mobil is a commodity business and the oil and gas industry can be categorized by boom and bust cycles, we're going to be using their average free cash flows over these years, including their last 12 months of free cash flow. That's a little over $5 per share. Then assuming that their cash flows over the next 10 years grow at the same rate that they've grown historically, which is about 5.5%. This historical growth rate dates all the way back to 1990. However, it is based off the business's historical performance, so it's an assumption that you need to validate or invalidate whether it's truly applicable for Exxon Mobil going forward here. Again, this is just going to give us a baseline into the future, and it's not likely that this is reflective of economic reality. This just gives us a baseline. Then if we're using a terminal stage for the 10 years out after that, with a growth rate of only 4%, assuming that their growth rate drops, so projecting Exxon Mobil out for the next 20 years and adding in their tangible book value today, then based on their average free cash flows, if you wanted a 10% rate of return for the business, it looks like a fair value for the company is about $109.45 per share. Couple of key caveats here. One, again, these are historical assumptions. And two, this rate of return would be including their dividends. Using these same assumptions based on today's stock price, it looks like you could reasonably expect about a 12% rate of return from Exxon Mobil over the next 20 years, even if Warren Buffett's potential hypothesis is that the pricing of these commodities are going to be higher long term. The oil and gas industry is categorized by boom and bust cycles. It's up to you to do your own homework to find out if these inputs into this discounted cash flow model are going to be accurate or not for Exxon Mobil going forward. So this type of analysis and this free cash flow model are not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. So in summary, Exxon Mobil checks the box on 4 out of 6 metrics. While their average returns on capital are just below average, over the past year they've done quite well, earning about 20% returns on capital. They've also grown their revenues, earnings, and free cash flows over the last 5 years, and they bought back a small amount of their shares outstanding. Then, even though the company levered up quite a bit during 2020, as their profitability has rebounded and they've been spending less on CapEx and not increasing their production. The company has had plenty of free cash flow to aggressively pay down this debt and to be able to support this debt load going forward. Over the last 12 months, they produced about $49 billion of free cash flow, which gives them a current free cash flow to enterprise value yield that's a little under 11%. However, their average free cash flow to enterprise value yield is below what the 10-year treasury is at currently. This again is because the oil and gas industry can be a boom and bust industry, and profits are highly dependent upon commodity prices, which can fluctuate wildly in any given year, depending on supply and demand forces. Then Exxon Mobil is also a dividend aristocrat. They've increased their dividend payments for each of the past 39 years, and they have quite a bit of dividend history. The company is a very old and established business that traces its roots back to Standard Oil, which was founded by John D. Rockefeller all the way back in 1870. Even though we saw some questionable capital allocation decisions to keep their dividend track record going, even despite a downturn in the overall business, their business has rebounded quite strongly since the pandemic, and their capital allocation strategy looks like it has not come back to hurt the business. Then finally, using a discounted cash flow model based off their historical abilities to grow their free cash flows over time, we learned that at today's prices, you could reasonably expect about a 12% rate of return going forward on Exxon Mobil over the next 20 years, including their dividend payments, if their historical abilities to grow their free cash flows are applicable for the business going forward. There are a lot of potential reasons that this would not be the case, and so that 12% rate of return really only serves as a baseline suggestion for the future. This analysis is not financial advice, and it's not a buy or sell recommendation of any security. Instead, it really serves as a beginning starting point to get a holistic sense of Exxon Mobil as a business and help you determine for yourself whether it's worth your while to dig in and do more homework about Exxon Mobil going forward. If you're interested in learning more about the company, I'd highly recommend starting with their filings. Read through their 10-Ks to get a history of the business and their operating results. Management will also outline potential risks that the business faces, as well as provide an overview of the environment that the company operates in. By reading through these 10-Ks, you'll also get a sense of both management's competence and their character, especially when it comes to their strategic planning and their capital allocation going forward. When you're finished with that, I'd also recommend reading through their 10-Qs and reading through the transcripts of some of their recent earnings calls to get a better perspective of the business on a quarter-by-quarter basis going forward. As a value investor, you're ultimately trying to understand a business as if you're owning 100% of it, and you truly know all of its ins and outs and can understand what's important and what's not, so that you can understand the underlying essence of the company. Through this background research, you'll be able to learn both the qualitative and quantitative aspects of the business, which will help you determine an appropriate value for its intrinsic value. And then you can compare that to how the business is currently priced by the market. That deeper level of understanding is ultimately how you're going to determine whether there's a margin of safety in the business or not. So with that said, that's it for today's fundamental stock analysis of Exxon Mobil Corporation, ticker symbol XOM. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Exxon Mobil was a subscriber request, so I'm happy to analyze the company. Thanks for learning about Exxon Mobil with me today, and have a great day.